Good evening. The financial year is just about over in most of the world, and the picture that we paint of 2011, I'm afraid it is of one colour, and one colour mainly, as you can tell. In fact, in sympathy with these colours, just look, most of the world's major stock indices got burned as the euro debt crisis intensified. The US lost its pristine AAA. 2011 was rugged. It was dangerous to your wealth. So we're going to spend the next 45 minutes looking at the big narrative. And we put together more than just an arsenal of facts and figures. Let's light the red light to prove that it was such a difficult year for investors. So in this programme, we'll ask where the smart money is and where you can find a return next year. Because frankly, even when there's no recession, to have the DAX down 15.4%, the Nikkei off 17%, the Hong Kong Hang Seng down 20%, only the Dow looks like it's going to eke out a small gain. It gives you an idea on the super screen of how bad things really are. And this is where we begin. Let's talk about the DAX. Starting in March, where we saw Japan, of course, the disaster that took place, beginning with the earthquake, the tsunami, and then the nuclear power plant at Fukushima. Those global worries hit the country badly and hit the international markets, which continued right the way through until the summer. It was in the summer when the crisis of confidence in the Eurozone really hit. And just look what happens to the DAX as we go into August, way down, and it stays down right the way into the autumn, into October, with the Euro summits all the way through to the end of the year. And what you see with the DAX, if I draw the line across badly, it never really gets above the line from where it started the beginning of the year. Throughout the 2011 Eurozone contagion, fears simply were everywhere. Worries that debt crisis and could spread to Spain and Italy. And of course, even in the United States, the Dow Jones was also badly affected. Let's follow the year as it was seen through the Dow. Go to the summer and you have the US debt debacle and the downgrade. Lost its AAA. Went to AA+, and there, of course, you saw the markets. And that, of course, continues right the way down through. It plunges 500 points, continues to fall, and the Dow, unlike the other markets, the Dow actually manages to eke out a gain, and largely because of the blue chips. McDonald's, for example, up 31%. Shares of IBM, Warren Buffett's favorite stock, also gained 27%. And if we draw that same line across that we did earlier, you see, it's a bad line, but you see there were large parts of the year when the Dow was in profit. So overall, the Dow did remarkably well, all things considered. On to the other markets. The Italian bond auction became the star barometer of the state of the Eurozone crisis. A year ago, Italy's 10-year was shaking nerves at 4.8%. 12 months later, and of course, as you know, it's 6.9%, it's 7%, and it's once again causing a real crisis. Italian debt will be the touchstone for us to watch for as we go into 2012. On the euro, it nudged up a bit today after 17-month lows. But frankly, keep an eye on the euro. There are some people who say it could trade to 118 as it goes through 2012 too. And it was volatility, volatility, volatility. The S&P 500 started the year with a rally. It touched a three-year high in April. But frankly, with the sort of volatility that you see in these charts, you start to understand why it was such a very difficult year. How on earth anyone can make investment decisions with this level of volatility is one of the things we now need to talk about. The turbulent year, it was preserving capital that was the name of the game, especially when the benchmarks were so volatile and downright miserable. It's not the whole story, as I found out when I spoke to Valentin van Nieuwenhuizen, head of strategy at ING Investments this afternoon.
It's been the year of living dangerously, hasn't it? It's really spectacular. And to some extent, you could say that after everything we have gone through with respect to the euro crisis, these numbers are even not as bad as feared in the middle of the year.
It was the middle of the year, wasn't it, when we saw those very sharp falls in August. And I still am not sure, as I reflect back, what caused it.
Well, it is. I think there is still a lot of discussion about that. Was it the debt ceiling discussion in the US that sort of pulled the trigger? Or was it basically an accumulation of stories surrounding, sort of disarray in Europe? Or was it basically a cyclical slowdown? And I tend to feel it's a combination of the two latter factors, whereas the debt ceiling discussion, in my opinion, hasn't been a dominant driver of markets in the summer.
The fact that we are seeing equities at these depressed index levels, or the indices at these depressed levels, 2 years after the recession ended, with a double-dip recession next year, it does not give cause for much encouragement for next year, does it?
No, it's going to be a very challenging year. I mean, of course, there is a significant valuation and attractiveness in equity markets if you look at it from a distance. But given the challenges ahead, given the ongoing drive for deleveraging in the public sector and a large part of the financial sector amongst households, the growth perspectives are simply too weak and too uncertain to really have a strong view and a strong positive tilt in financial markets at this point.
So, where do we put our money next year? That is the whether you've got 1,000 or 10,000, $1 million or a $10 million question.
Yeah, well, I think you want to at least be sure that you're getting some return, but not necessarily you sort of gamble on too much return. So we tend to be relatively constructive in fixed income markets for as long as you're outside of the European peripheral markets. But if you have a spread portfolio, diversified portfolio in treasuries and also in high-yield bonds, emerging market debt, that is probably the areas where you get relatively nice returns and get well rewarded for the risks that you're taking.
And if you
on equities...
Yeah, well, I was just about to say, if you do have to put your toe into the equity markets, I mean, the word I hear is is value stocks, the sort of what in the old days you and I would remember we used to call the defensives, the non-cyclicals, the pharmaceuticals, the defensive stocks.
Absolutely, whether we call it defensive, low fall, value stocks, that is an area where you want to be invested. Although I would like to point out that, we have recently shifted from a very defensive stance in the middle of the year to sort of more a neutralish stance comparing cyclical stocks to defensive stocks. And we're doing this in anticipation that somewhere in the first quarter or maybe early second quarter, we will get some better cyclical backdrop and we will get a sort of better, although it might be temporary, but a better environment for cyclical or high beta stocks. So be prepared to be dynamic and switch your positions because holding on to one style will be way too costly and risky.